What I'd like to talk about is what we do as a company and why that's relevant and why that's important, and talk you through some of the thinking about why we've been through this quite significant transformation as an organisation. My background is actually in technology. I'd worked for one organisation for my entire life prior to turning up at Lombard Risk, and that was the Royal Bank of Scotland, formerly NatWest. And since about 2000, after a few years messing around doing various things, I'd held reasonably senior technology jobs. I ended up on the investment bank running all of the back office for the investment bank, all the back office technology. And then after some messing around with a small Dutch adventure called LRM.L, you probably won't remember it, wasn't very widely covered. I ended up being the Chief Information Officer for the International Bank. So I have a lot of experience of buying software. And I think one of the reasons why the board maybe selected me is that buying software in banks has changed. Back in 2000, when I was running FX risk management systems, we would never have dreamt about buying anything. And admittedly, that was front office, and we had a competitive advantage in terms of our interpretation of the various surfaces and stuff we were modelling. But right throughout the bank, we built everything, and we were quite arrogant in that assumption. By the time I came to finish, and I was running back office systems, then our international network, we were buying everything. And RBS indeed has gone a step further than that now. They've started buying front office risk management as well. So the landscape has really changed in terms of how technology is delivered into the biggest of the big financial services organisations. And I've had experience of what it's like to be on the other side of the fence buying to that. And banks are different places now. They have procurement and technology and business stakeholders and a whole competing array of people inching their way slowly and tortuously to a decision. So I think that was part of the attraction. Technology is a big part of our DNA, and I think the board were quite keen to get someone in with technology experience. I'm going to talk a little bit about the move from Shanghai to Birmingham. I think it's interesting, but it's a very, very important part of our strategic play. I've done it the other way around. At RBS, I moved a lot of our development to India, and there's good ways of doing that, and there are bad ways of doing that. And again, I bring that experience to bear. And I think the other thing to say is that Lombard Risk has grown from a tiny little company. It used to run a product called Oberon. I don't know whether anybody with a risk management background's heard of it. It was incredibly popular in its day, very, very successful, still actually generates a modest amount of revenue for us each year. And now it's a sort of a 350 plus organisation distributed globally. It's been through quite a lot of chaotic transformation. Chaotic transformations don't come much more exaggerated than the ABN AMRO one, and again, I come with that experience. So what do we do? Well, our strapline is that we apply our extraordinary expertise to liberate clients from operational and regulatory complexity. And what does that actually mean? The businesses that we're in are not core to the business of banking. These are things that banks and financial services organisations have to do in order to win their licence to operate, their passport to the pitch, to be allowed to be in business. And therefore they're a distraction and an irritant. And the onus on banks to comply has grown dramatically over the last decade, obviously in the wake of the financial crisis, but again, as regulators have sought to control businesses. So thinking about our two lines, on the regulatory reporting side, my first interaction with anybody from regulatory reporting was in 1996, I think, and there was two people working in a garret at 135 Bishopsgate. They'd been put in what wasn't much more than a broom cupboard, and they were responsible for regulatory reporting for the bank. Now, there are hundreds of people filing an amazing amount of returns to a credible array of regulators, and in every geography, I'll be showing you some logos in a minute, there are multiple regulators. And because of the way these regulations have rolled out, banks have gone and solved those problems in a serial fashion. And what they're now left with is this incredible legacy of technical debt, stuff that's expensive to run, difficult to operate, requires changing regularly, and they're frightened to change. And what we offer is a solution out of that. On the collateral management side of it, collateral management, when I was responsible for it as a portfolio of responsibilities, when I ran back office technology at RBS, was a tiny part of our business. It was a few niche products, a few customers that we trade with on a collateral basis. It now underpins the entire operation of the derivatives market, and you can't operate in buying and selling derivatives unless you are calculating initial and variation margin. And whilst those rules today apply to the biggest players in the market, and we have some of the biggest players in the market as customers, they are cascading all the way down. And the way in which collateral is locked up inside your organisation, if you haven't got a genuinely cross-product collateral management solution, we would argue that you're likely, and we not just us, people like Accenture would argue, you're likely to be leaving a huge amount of money on the table in terms of inefficiently allocated collateral. We think there's one product in the market that solves this problem, and we think that product is Colleen, and what is going to become Agile Collateral, our next generation of Colleen. So, again, very, very important. The expertise piece is what Lombard was built on. So our founder, John Wisby, was an ex-derivatives trader, attracted a number of people into the firm that were real practitioners. We are stocked full of regulatory experts, people with collateral management backgrounds that have worked in the industry. And that expertise is really, really important. But the other thing that we've really tried to add to it in the last couple of years is a real expertise in terms of this delivering software into banks, completing the sale, implementing the software. So again, I'm going to talk a little bit about that. So in terms of regulatory reporting, I'm going to share with you some of the slides that we use for our pitches. As I said, I want you to get a better understanding of what we do as an organisation. I'm not going to drill down in them deeply. You might well have seen this one already, and I think wherever you're sitting, it's almost certainly illegible. That's part of the point of this slide. Each one of these is one of the hubs, one of the individual challenges that are thrown in a bank's way. This goes back years in terms of challenges that banks have already had to comply with. And every one of these humps, when tackled independently, is an independent event which creates technical debt and creates complexity. When we sell a regulatory reporting solution, we typically do it on a 5-year basis, and we typically charge an initial license fee, which we'll negotiate depending on the complexity, the size of client, etc. We'll charge implementation fees as well, that's a separate thing. But we will then tend to charge our clients 34.5% per annum on maintaining that regulatory reporting solution. And the reason why we charge such an extensive maintenance rate is this stuff changes all the time. We don't support South Korea. The regulations in South Korea change once or twice a day. They are constantly tinkering with them and constantly requiring banks to adjust and fine-tune their regulatory returns. Our friends at the Financial Conduct Authority and what's the Bank of England again now, but what used to be the PRA, don't change that frequently, but every quarter there will be guidance coming out. The stuff that comes out from our reg experts about things that people need to comply with and the changes are enormous. So you can imagine that if you're a bank and you've tried to comply with these on a one-at-a-time basis, you're in some trouble as those changes come out. Furthermore, from my perspective, every one of these new ones is a fresh sale opportunity. These are deadlines that have to be complied with. Right now, we are mobilising teams in Australia because the Australian Prudential Regulatory Authority are finishing their consultation. That consultation will then come with a bunch of drop-dead delivery dates and a bunch of foreign banks who have one set of complex reporting requirements, and the big incumbent domestic players will be on a treadmill to completion. They have to comply or they lose their license to operate, and that's our business, so they're compelling sales. This line here is what we see as the opportunities grey line for a strategic investment. And our product Agile Reporter, those are the logos of some of the different regulators we support. Our product Agile Reporter is designed to try and take that risk out, to connect to data sources in a single way, to use common calculation analytics where it's appropriate, and then get deeply personal with individual regulators, making sure that the format and structure of data that they wanted is met, and there's a whole control process around that. And I don't think I can claim that this is unique. I know a couple of our competitors, Axiom SL and Wolters Kluwer, that are trying to develop the same kind of thing, but I feel very strongly that we have a significant march on this. And we don't just implement it ourselves, we can put this into any data sources you like, but we also do this in conjunction with Oracle. So if as a bank, you've sort of tackled your enterprise data architecture problems from a first principles basis and put in place the Financial Services Data Foundation, which is an incredibly smart move. It'll take you a very long time to implement and cost you a fortune, but it'll leave you in very, very good state and eliminate a lot of manual reconciliation processes from your organization. When you want to turn on reporting, the reporting solution to turn on is Agile Reporter. Just back to some of those logos again. I mean, this illustrates the problem. All of these top logos are US regulators. So if you're a bank, you're immediately having to file similar but different returns to a bunch of US regulators. In Europe, the EBA and the ECB. The ECB's just woken up with its anti-credit regime, a very intensive data scheduling thing that we expect to be doing a lot of this year. MAS and the Hong Kong Monetary Authority, different countries trying to outdo each other with an incredibly similar set of regimes. Most people that have a foreign branch in Singapore will have one in Hong Kong as well. The Bank of England and the FCA, again, I met with both of them 2 weeks ago, talking about what their priorities are. Similar but different, all united by exactly the same aspirations to better and more effectively understand the systemic risk that the banking system is as a whole, but dependent on drawing that data from a collection of sources. This briefly looks at those 3 different stages. So again, here's the sort of the data. I'm not going to drain this slide, it's more of a product slide. This is the sort of the integration into your data architecture. If you've got a load of different data systems, you're probably looking at a multi-year engagement with our professional services consultants. We work for I'll name them, they don't like being named, but the Bank of America. We've done to work with them domestically, but we've done a big piece of work for them in Hong Kong and Singapore. We were there over a year, plumbing in their data sources into our model. Really difficult, fiddly work, of which the integrity of everything coming off this back end absolutely depends upon. On the computation side, again, as I said, trying to get some consistency around that. If you're bucketing up a portfolio of loans or a roster of credit card transactions, they're fundamentally the same thing, whether you're reporting them to the APRA, the PRA, the MAS, the Hong Kong Monetary Authority, the Fed, whoever. So trying to get consistency around that and make sure that technology investments that the bank has made can be built upon and replicated and leveraged elsewhere. But then when it gets down to here, being really deeply specific and making sure that the edit checks, the validation checks, the controls around submitted to a regulator are really, really tightly run. So that's Agile Reporter, and that's what we do in the reporting space. And as I said, I'll talk a bit about our partnerships at the moment, but Oracle is a key strategic partnership for us. It sits on the back of the Financial Services Data Foundation. Now, if I think we have a commanding position in terms of regulatory reporting, and we have an answer that's incredibly plausible in the future, when it comes to collateral management, I genuinely believe that we are number one. The key thing about effective collateral management, once you get to a certain size, is that all these different asset classes, repo, ETF, ETD, OTC clearing, whatever that, if you haven't got them linked together, you're not going to be able to do cross-product margining effectively. Every bank that I've ever come across has gone and developed capability in each one of these silos as a tower. Banks in the early 2000s in particular, when a lot of money was being spent on technology, were not short of investment dollars. They were investing very, very substantial sums of money, and individual departments were making their own decisions. So if you were running the repo department, you slammed your fist on the desk, you said, I want my guy to do it, these are my requirements, I'm making bucket loads of revenue for the bank, and everyone put their hands up and said, yes, whatever. Those days are over. A, those revenues aren't there to support that investment anymore. B, revenues are compromised to the point that optimizing collateral actually becomes an important and relevant thing to do. And when you sort of start looking, you say, well, which of these assets can we build on? We've got all of these different towers in our banks. Which of them makes sense for us to build out and go across and create that? It's really hard to do, because the repo one might be the best, but it isn't well suited to these other asset classes. And the guy running it, everybody knows that when it comes down to the technology prioritization, it's going to be their agenda that gets up to the top of the tree. And trying to get something in from ETD is going to be really, really difficult. So there's huge political inertia for banks to be able to do that. Meanwhile, Chief Information Officer has a pressing mandate to dramatically cut his technology costs and has very, very few places to go in terms of doing it. So it's a massive issue in banks. There's one competitor product that we go head-to-head with a lot, and that's SunGuard Apex, or FIS Apex as it is now. And like a number of things they've done, their different modules have been acquired through different acquisitions, and they haven't really done the investment necessary to make that interoperate together. So when we get a fair fight, when there's no sort of incumbency factors, or there's no sort of strong preference that we can't undermine on the selection thing, we tend to win those deals. And we won a very important deal, which we can talk about, SocGen last year, €5 million total value deal. SunGuard had popped the champagne corks on that one. They thought it was done. And we went in there, and we're not very good at the fear, uncertainty, and doubt school of selling. We're getting better at it, but we haven't been very good at it. But just by being honest and talking about what we did and pointing out the weaknesses of failure to integrate these pieces, the power of these things that sit around the edges in terms of what they do, turned that sale around, and we ended up displacing SunGard and taking over for the business they acquired as Nuex, their new prime broker. So that's what we can do, and I genuinely think that Colleen is one of the best of breed. It works right the way down from some of the top tier one banks like SocGen, Deutsche Bank, Commerzbank, Lloyds, other big clients, and we are driving into the buy side now. I've got deals live at the moment with corporates that are affected by the IOSCO rules that I talk about here. These sort of regulatory changes that are driving the way that the derivatives market is operated. It's been implemented as part of the Dodd-Frank regime in the US. It isn't going to be taken out as part of Trump. That's not one of the things he's after. It's been implemented by EMIR in Europe, and Asia's coming along. So, we're very, very pleased with what we have here. In your deck, I'm not going to drain this now, is some more information about some of the things we do. This is the kind of the comprehensive offering that we have. And the important thing about this is that other firms like Calypso and Murex will try and sell banks a sort of a module, a collateral management module, which will basically do some of the inventory management, some of the backbone of this, and some of the margin call stuff. But when you actually want to do, scenario analysis around, making sure you're placing your capital in the right place, the optimization calculations themselves, or managing your operational risk, our products again can demonstrate, really significant operational risk management and cost savings. And then obviously, in the collateral marketplace, connectivity is everything. We operate as part of an ecosystem, and making sure that we are part of that is crucial. The future of Colleen, if I had more time this week, I'd have put you a nice screenshot of what it's going to look like, is we are very concerned that we make our collateral system much more cloud friendly. It's not so important with the regulatory side. Our regulatory product is all web-based. Oracle like to say that it's cloud deployed as it is when they go and sell it with us. But in actual fact, the data for reg reporting is so embedded in a bank's data architecture, it's almost impossible to liberate. It's different with collateral. You can pass files up. You can effectively outsource the responsibility of hosting that to someone else. And we've got about half a dozen clients where we host them already. So we've got about 70 collateral clients, and we host about 6 or 7. I can't remember the exact number. What we'd like to do is, as we roll it out to the small clients, is make that much more of a normal thing to do. And we think that this market will probably go cloud quite quickly. Certainly at the smaller end, I don't know when the biggest banks are going to go cloud. But certainly, we've had a lot of success in Canada. Some of the biggest Canadian banks have been very keen to understand that we have a credible cloud-based solution. And then on that basis, they've signed up and hosted it themselves. But they'd like to know about that. So Agile Collateral is the next generation of Colleen, and it's where we'll be making our investment. So that's Lombard Risk. We're a RegTech firm. RegTech's the new sexy firm for doing some things that, let's face it, they're not the most fascinating things on the planet. But it's got this nice new exciting title as billions and billions of dollars are pumped into the overall compliance agenda. And we only have a part of that, but an important part. We believe we've got a fintech attitude. So we're a small, nimble company. We have offices, sales offices in New York, London, Hong Kong, and Singapore. We've got boots on the ground in Australia, Tokyo, and Frankfurt. But we are, we are agile in our approach. We believe we have a fintech attitude when it comes to working with clients and not just delivering them the solution we happen to have, but understanding their needs and working out what we can do. But equally, the problem with fintech in this space is it's got little innovation to offer, but obviously it's huge risk. So if you set up a startup business yesterday, you're commuting to your shed on a skateboard, banks take that quite seriously and they're quite concerned about it. We've got a 28-year track record. And as I said, I've talked about why our products are market leading. We've got an enormous number of clients in the reg space, over 300 clients. We support over 20 regulators globally. Someone added up, we do something like 250,000 reports a year that we submit or allow the facilitated submission of on behalf of our clients. Collateral management, it's less than that. It's about 60. I think it's actually near 70 now. And our largest client has got what we call 35,000 credit support annexes, the sort of the bit that sits at the back of an ISDA document, which handles collateral rules. Our smallest has just got 10. So that's the magnitude that Colleen works for and operates on. And we've been doing Colleen for over 11 years. Talked a bit about our alliance partners. I talked about Oracle. As I said, they're really fundamental to us in the Agile Reporter space. And indeed, as we're sort of firming up our strategy, I talked a bit about Australia, you know, a real twin track approach in Australia. When we're working with the Chinese, the Taiwanese banks, etc., that are very, very prevalent in Australia, that's our historical bread and butter business. We'll just do that ourselves, and we'll get in and provide them very, very effective data integration services. When we're talking with the big players in Australia, the domestic players, we'll do that hand in hand with Oracle. They're making big, brave data decisions, and if you've done that kind of work, Agile Reporter sits very, very elegantly on top of it. Got another important client that's on the collateral space, Atos. You may have seen it announced if you've been following us at all. Atos is working for us at the moment in the German marketplace. The problem with Germany, for people that know much about cloud, is that the BaFin regulator there very, very worried about non-German cloud stacks. Microsoft made a big announcement last year about what they were doing with their Azure facilities. We use Amazon Web Services. That's our preferred platform of choice, as the one we know the most about. Atos have got a BaFin approved environment, and we're going to market them. Also opens up a range of German corporates and smaller institutions that will be affected by these IOSCO regulations, but are not yet, you know, they don't have a lot of English skills. We have one Irishman that speaks pretty good German, but you know, Atos is a big important thing for us there. We've got a number of people that help us in, you know, when they're involved with vendor selection or help us with implementation. So PwC, Accenture. We don't have a formal relationship with Deloitte, but we work very, very close with them in the US on a number of things. NS Solutions and NTT Data in Japan, and then part of the ecosystem, Acadiasoft, Razor Risk, Message Automation. If you're in the collateral space, you will understand what some of these outfits do. Again, very, very important relationships that we have. I think I've got 15 minutes. I think that's meant to include some questions. So quickly, in terms of our financial overview, what we needed to do last year, when I sort of started in December and sat down with Nigel and the other executives on the board, is we realised that there was some serious investment needed in the business. We had a vision for Agile Reporter, which we believe is, you know, would put it front and centre of anybody's decision-making process, but it needed work to get there. We'd been talking about it as a firm forever. We had to industrialise our implementation of Clean in the cloud. We had to make it out of the box. It was no point us doing the type of, you know, work that a client would have to do to create a hosting solution. You can't talk about implementation. You have to talk about onboarding. It has to be key. And I wanted to build a world-class development centre much, much closer to headquarters. And this is an important part of some of the work that Lombard's engaged in at the moment. For 10 years, we've been developing our software in Shanghai. And I think 10 years ago, the decision to do that was probably a different one. We were a very small firm. We had some local connectivity into that market. It wasn't so hot. Now, Shanghai in no way can be called a low-cost centre. It's a very, very expensive place to do business, and paying there, you know, way in excess of 50% of the wages I pay in Birmingham, which is the centre we selected. The way the Chinese tech market is structured, the majority of people in Shanghai want to work for the big Chinese national companies. Didi Xcheng, the firm that bought the Uber Chinese assets, Alibaba, the sort of the equivalent of eBay. And after that, they want to work for Google or Microsoft or Western brands they've heard of. So we find it really, really hard to attract talent in. We had about 160 people there, and a lot of them don't speak English. So about 2/3 of them don't speak English at all, and the quality of English in the other third is variable. So unlike my experience in India, where we interviewed everyone in English, that was the de facto language for the development centre, really difficult. That elongates your development cycle. So you have to write very, very specific requirements documents, translate them into functional specs, literally translate them into Chinese, and then do the work and then test it. And it takes a long time, and the quality, it takes a lot of effort to make sure the quality is at the level that we expect to be able to deliver to our clients. So we wanted to make a big change to the way we develop software, and as I said, that was the other part of our fundraise. We raised 7.9 million to do all three of those things, and in return for that, we said we'd try and do two things. The first one was to deliver a step change in revenue performance. So Lombard for a long time had this history of regular, frequent working capital raises and not delivering the revenue. The revenue would grow, the cash would, you know, the expenditure would grow. So we said we can deliver the step change in revenue performance to sort of like get ahead of that. But, you know, we'll spend the money last year, and then we'll position ourselves this year for cash profitability. We'll make sure as much of that expenses as possible is one-offs. So where are we in that plan? We're literally halfway through it, plus a couple of months. We did manage an almost 45% growth in revenue last year. to 34.3 million. We grew our recurring revenue by 21%, and we grew our order book from 7.5 million to 10.1. So order book is software and services that we have sold. We have a signature on a contract, but we haven't yet implemented, and therefore we can't yet recognise. We for a long time the accusation levelled at Lombard was that our cash burn was too much and we'd run out of cash. We ended up with a cash balance of 7 million at the end of March, way ahead of where the analysts thought we were. And our adjusted EBITDA was 2.6. We did make a loss before tax of 1.6, and this is on a capitalised basis. So not trying to hide anything from you. We've had this capitalisation policy that neither Nigel nor I put in place. It's been in place for 5 or 6 years now, and it does flatter the figures. Our intention is just to ignore that and get over it and get the firm to a cash profit. So you've got in your pack the actual numbers. As I said, I don't really want to dwell on those, particularly today, beyond giving the highlights. We did cover this extensively in the session that we ran, and I'm running out of time for questions. And I'm going to be around, as is Nigel, afterwards, if there's specific things that you want to talk about. They're all in the deck. I'm sure that's not visible at the back. In terms of where Lombard is today, I made a number of executive changes. So I like Nigel, kept him, but I did change the CTO. I did appoint a head of product. For a product-led organisation, there was very little product leadership. And we've made a lot of changes in the sales leadership. As I said, we tried to move from an organisation that really didn't like salesmen very much to one that didn't like them very much but tolerated them and admired them for what they did. To one that where the sales group understand that thing I was talking about in terms of how you navigate a bank, how you get in, how you work with procurement, work with technology, as well as the business stakeholders, the people who you think you have the relationship with. We've invested enormously in Asia in the last year. Lombard sort of had this accidental success that I cannot track where it came from, where we've acquired a large number of foreign banks reporting in Hong Kong and Singapore. And we had these offices, 2 offices, one in each place, obviously. So not particularly efficient, and it wasn't really sustainable. It wasn't contributing to the bottom line. So I've hired a new head of sales there, hired a new sales team. The sales team in Asia is entirely different. Scale back what we're doing in Japan a little bit. So I've got to hold and wait and see strategy in Japan. We've got 4 clients there. I'm trying to make sure we service them and think about how the Asia implementations, those IOSCO regulations, will affect Japanese prospects. But then seriously investing in Australia. Australia for 2 reasons. One, we just had a huge amount of success in Canada, toppling over a smallish client into Collateral Management and then ending up with 4 of the top 5. We think we can repeat that success. We've got pitches ongoing with some Australian banks, and we currently do Bank of Queensland. But also, as I said, because of this APRA change. So this consultation period, as part of that graph I showed you earlier, we have a point of inflection in Australia where most of the market is greenfield sites. They don't have an incumbent. They use their own Excel solutions for a very modest array of reporting. Australian Prudential Regulatory Authority has read the output of every large regulator on the planet and is trying to outdo them all. So this is creating an enormous amount of work for banks. It starts in June. We're set up and ready to go. As I said, with Oracle for the Big 4, by ourselves for all of the other banks, and for our particular friends, sort of the Chinese, Taiwanese banks, etc., who are operating in Australia. The other thing that we're really emphasising is the cost reduction opportunity. So again, I talked to you in the collateral slide about how by optimising those individual silos, you take the opportunity to actually decommission systems. Decommissioning systems saves you a huge amount of money. Getting us to run this for you rather than having a dedicated team of technology talent that's difficult to hang on to anyway, and you're probably overpaying, gives you some quite significant cost savings from a technology perspective. We can also demonstrate in terms of operational savings how more efficiently you can run both reg reporting by centralising it and collateral management again through that bringing together the different asset classes. Our roadmap is very well validated because we have so many clients. We've got sort of over 350 clients when you add the 2 together. So we've got a lot of opportunity to talk through what we do with people. So again, we feel very confident about getting through. Our priorities this year are all around getting back to that cash profitability position. I say back to, it's a long time since Lombard made a cash profit. Moving lock, stock and barrel to Birmingham. Our commitment is to try and be done there within the year. Huge job lots of delivery. We're not happy with the way software is developed in Shanghai, but a lot of people, a lot of deliveries depending on work stacks up there, building a team. We're down to about just over 100 from 160 in Shanghai, now 170. So we've let 60, 70 people go. We're up to 35 in Birmingham. That's very much the model, 2 for 1. So we think the productivity savings that we can get by compressing the development cycle, working in a more agile way, allows us to pay not quite double for a Birmingham developer, but get one of them for every 2. And then considering Agile Reporter and our Lean work. Hannah is glowering at me. So there's the summary. The blocks are in the diagram. Importance of partnerships going. What I didn't say is that future growth will be, we're looking to partners to deliver that. I hired a new director of alliances. Happy to talk a bit more about that if people are interested. And we're halfway through our story.